If you're looking to give back to causes you care about and save taxes while doing it, this video is for you. So today we're diving into smart charitable giving strategies that can reduce your tax bill. So whether you're still working or already retired, you should be able to find something in here that can help you today. But first, hi, my name's Kurt. I'm a certified financial planner, and on this channel, we explore money and meaning. So if you're ready to make your money do more good, hit the subscribe button and let's get started. So first off, let's talk about why this even matters. If you are charitably inclined, you might think that if you just write a check to a charity, you automatically get a tax deduction. But with recent changes to tax laws, most importantly, the higher standard deduction, fewer people are itemizing. And you don't get to deduct the charitable giving if you don't itemize. The standard deduction for 2025 for a married couple filing jointly is $30,000. This is the amount that you automatically get to deduct from your income, regardless. So what this means is that many of us are giving donations, but we're not really getting a tax benefit for it. So if we want to have a larger charitable impact and lower taxes at the same time, we have to find ways to get smarter about our giving. So the question is, how do you give in a way that helps others, but also helps you at the same time? The answer is tax smart charitable giving. So let's break down some of the most common strategies. Strategy number one, you donate appreciated in assets instead of cash. So instead of writing a check, consider giving stocks, mutual funds, or ETFs that have gone up a lot in value. Why would you do this? Because when you donate appreciated investments directly to a charity, you avoid paying capital gains on the appreciation, and you can deduct the full market value if you itemize. So think about it. If you had a stock that you bought for $10,000 and now it's worth $50,000, you could get a $50,000 deduction and avoid paying taxes on that $40,000 gain. Strategy number two, a donor advised fund. So this is like a charitable giving account. If you've ever wished you could set money aside for a charity now and get the tax deduction, but then take your time on deciding where to give, this is for you. This is how they work. So first, you do have to contribute to a DAF, a donor advised fund, and then you get a tax deduction in the year that you made the donation. But from there, the money can grow tax-free inside of that fund. And you pay money out kind of as a grant to your favorite charities over time when you decide. These are really perfect if you have a high income year or you've sold a business, but you aren't quite sure yet which causes that you want to support. Strategy number three, qualified charitable distributions, QCDs, from your IRA accounts. Okay, this is for my folks that are over 70. If you're taking required minimum distributions or RMDs from your IRA, but you don't need all that income, a qualified charitable distribution would let you send up to $108,000 for the year 2025 straight to the charity, tax-free. So this means it counts as your RMD for the year. You don't pay any income taxes on the money you give, and you give directly to the charities that you love. So there's no need to itemize on your tax return for this one. Every retiree should know about this one. Strategy number four, bunching donations for a bigger tax impact. So here's a trick called bunching. Instead of donating a little bit every year and not getting over that standard deduction, you could combine multiple years of donation into one big donation in 1 year. So here's an example. Instead of giving $10,000 every year, you could bunch 3 years together and give $30,000. So now you can itemize that $30,000 in deductions. And in the next 2 years, you would just take the standard deduction. Strategy number five, you can offset taxable events with charitable giving. So if you had a big taxable event this year, maybe you sold a business, maybe you got a big bonus, or maybe you converted a lot of money from a traditional IRA to a Roth IRA, using charitable donations to offset that spike in income could save you serious tax dollars. So for instance, if you're doing a Roth conversion, which bumps up the tax bill in the year that you do it, giving some money to charity in that same year can help neutralize some of that added income. So now you're being both strategic and generous. And strategy number 6, charitable remainder trusts and legacy giving. Now, this is a bit of an advanced topic, but if you're in a place where you think about legacy planning and lifetime income, there's a more advanced estate planning tool called a charitable remainder trust, or a CRT. A CRT lets you receive income for life for an asset that you put in the trust, but then after you pass, the remaining funds go over to the charity. So it can be a very powerful way to generate income now, but also leave a charitable legacy for later. But this is definitely one you want to set up with your financial advisor or estate planning attorney. Now, let me give you a real life example of how we've seen this in practice. Meet Susan and John. They are in their mid-70s, so they're taking their RMDs. They're comfortably retired, but they have about $1 million in an IRA. But they decided that they don't need the proceeds from their RMD this year, which would be about $40,000. So instead, they decide that they want to support their favorite cancer research charity. So instead of just writing a check, they use a QCD to send that $40,000 directly to the charity. So they ultimately avoid taxes on that $40,000 because it counts for their RMD, and the charity gets the full amount. That's smart, right? Now imagine you're able to multiply that type of impact over several years. So let's recap these power moves for giving smarter. Number 1, donate appreciated assets. Avoid the capital gains altogether. Number 2, donor advised funds. You give now, you decide later. Number 3, qualified charitable distributions, tax-free IRA giving. Number 4, bunching donations. You maximize your deductions by lumping many years of giving all together. 5, offset your taxable income by giving big when you have a big income year. And number 6, a charitable trust. Income now, you give it away later. Whichever you choose, this is about aligning your monetary giving with your monetary meaning. Charitable giving isn't just about cutting a check. It's about being strategic so you can give more and save more. And if you're curious about which strategy might work for you, especially with retirement and tax planning in mind, reach out to us to discuss how to align your money and meaning. And hey, if you found this helpful, don't forget to hit that subscribe button and follow. Thanks for watching. We'll see you next time.